Hi, this is Rob and Mike from the McClellan Financial Group, and this is Think Smart with TMFG. Mike, I've been reading recently about, that the value premium has disappeared and that times have changed and that we maybe that value premium won't exist in the future. And the value premium is essentially that cheap companies, if you buy them when they're cheap, will deliver a higher return than if you buy companies that are growing quickly and are priced at a much higher price. What are your thoughts on it? Do you think the value premium has disappeared?
On a temporary basis, last 5 years, we haven't seen much of it, right? But it's not that this has not happened before. We've seen the value premium disappear in the past. It gets very confusing now. The other day, I was just reading through all the ads that were coming in. I was just talking about different companies. And it started with Uber had lost $5.2 billion in the last quarter. And I'm shaking my head. I'm thinking, how can Uber possibly lose money? All that they do is they're someone that's an in-between person. They don't have employees. They're just paying a percentage of what they take into their riders. How do they lose this much money? Then you start to go look at other companies, and right across the board, I even saw Canada Goose yesterday came in as losing money. And these are very successful companies, which throws you off because they're doing very well. But it's become a different situation now where people don't seem to expect the profits as much as they have in the past. And I guess the question is, how long can this go on? Do people eventually ever want to get paid?
So I look at this and I always think of how difficult it is for a business to make a profit. You take it for granted. You're going to open your doors, your customers are going to come in, you're going to give them a service or a product, and you're going to make a profit. Does business really work that way?
Unfortunately, no.
So let's look at Uber. You create this great service that's expanding all around the world. But as you said, you don't have employees. You maybe have a few, but most of them are contract workers. You don't own the vehicles. Those are owned by the contract workers. And all you're doing is you're taking a piece of the fees that you're charging the end client. I don't know how they can't be making money.
Yeah.
But they're not.
And then you have companies like Lyft that are their competition is in the same situation, right?
And so they're changing the marketplace, but neither of them are making any money. And the only reason to buy a stock or to own a company is to really, if the company's making money.
See, the past way we used to think is you'd expect a growth company to eventually become a value company. That was the goal for every company, right? To eventually become a value-based company. And that means, I'll give you a great example. Apple's a great example of that. Apple was a growth-based company. It's almost a value-based company now, right? Because it has tons of earnings. It makes tons of products. People buy them. And when you look at Apple's actually a reasonably profitable company at this point. But it went through its growth stage where they weren't making any money. Apple as a stock until recent past years never paid a dividend out, right? They were a straight growth company. Just everything was being reinvested back into the company. And that made sense, but eventually we want all companies to turn into an Apple and start to make a profit. And I worry that expectation has been lost on a lot of companies.
And so you're just buying the stock based on the price going up, not on whether that company's ever going to make a dollar.
Yeah, which eventually has some problems attached to it.
So if we go back to the value premium, and if we look, the beauty of the value premium is that you can look back 80, 90 years worth of data and see that this premium does go in and out of favor. But if you look over periods of time, it always seems to be there. If the period's long enough, if it's more than 10 years, I think it's there 95% of the time. The problem is there's still that 5% of the time that it's not there over a 10-year period. I was out for a walk the other day, and I was sort of thinking of, all this negative news that is out there. And I was thinking, and I'm not going to get religious, but I was thinking for some reason, about the devil. And the devil, the expression, the devil's always trying to lure you in. Well, the stock market's a bit like that. It's trying to lure you in when things are good that you need to jump onto it, or when things are bad that you need to run from it. And there's been enough research to show that you really should just stay in the market and not try and figure out, follow the direction of the devil.
Yeah. Well, the reality is growth is sexy. That's what it is. The growth companies are Amazon, Netflix. They're sexy companies. They're really interested. You read the news. They're out there. They're interested in what they're doing. They are great companies because they do really interesting things. But the reality is, eventually, you have to have a plan to make money. And this isn't from any of my official research, but this is just what I find is a lot of times when you have corrections in the market, a lot of these growth companies drop like a rock because when the markets turn nasty, people are looking for some type of income from these companies. And if all of a sudden you're in a marketplace that no longer plans on expanding at 15, 20% a year, then you have to go say, well, what are we making right now?
Is there any dividends?
Is there any dividends? What am I being paid? Why am I holding on to the stock? Once you take that future growth at an exponential rate out of the equation, then you say, yeah, what am I making from owning this company? And people run from these stocks like crazy whenever there's any type of recessionary time. So again, you find the value premium comes up sometimes in not the nicest marketplaces. And that's why people don't understand the value premium as much as they hear the growth premium. Growth premium is preached very high because the market's doing well. The value premium is saving people as the market is turning the other way.
So is the devil preaching about the value premium these days?
No.
They seem to be preaching about the growth premium and move towards it and move away from the value premium. Those are the things when you make those mistakes. And, having been in this business over 25 years, I've learned that you can't listen to that noise. The minute you do it, you're going to do it at the wrong time and you're going to call it whipsawed. Yeah. The market's going to switch around. It's going to swing the other way. Value will suddenly come into favor and you won't be there. And yet you've just committed the past 8 years or whatever it was to value, and then you miss out on the reward.
It can disappear in a month. That's the reality behind it. People don't realize how quickly that value premium takes over and the growth premium falls off. And it's really a matter of patience. It's hard to be patient for 3 to 4 years for that 1 month that's going to make it all worth it.
So a good thing, if you've got something like Uber and you love using the service or you love the app, keep using it. I'm not sure it's a stock I want to own until they figure out how to make money.
Yeah, as long as they charge me $9.95 a month for Netflix or whatever it's gone up to now, I'm gonna have Netflix.
You're gonna have Netflix.
It's a pretty good deal,
right?
And I mean, I've started ordering things on Amazon. I love it. I mean, from a service, I got some stools for my kitchen the other day. They were $99 and they were delivered the next day. Amazing deals and very great for shopping. But when I look at how they make profits on that, it's difficult for me to justify why a huge portion of my portfolio is going to be based on a company that's not making any income.
Absolutely. Absolutely. This is Rob and Mike with Think Smart and TMFG.
You have been listening to the McClellan Financial Group of Assante Capital Management Limited. Assante Capital Management Limited is a member of the Canadian Investor Protection Fund and Investment Industry Regulatory Organization of Canada. Insurance products and services are provided through Assante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources, however, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances.